Welcome to vTalkInsight, Market Drivers Daily for December 19th, 2025. AI earnings, European geopolitics, and shifting growth expectations are all intersecting today, shaping how investors think about risk into 2026. Artificial intelligence remains the central macro and market narrative, and today the tone is tilting back toward the infrastructure winners. Micron's latest results, combined with still aggressive data center build plans, are reinforcing the idea that demand for AI compute is not just hype, even as concerns about valuations and financing linger. Earlier this week, the focus was more on how to fund highly leveraged data center projects. Now the discussion is shifting toward how far this capital expenditure wave can run before it hits hard limits in energy, regulation, or investor tolerance for cash burn. Micron reported a 57% year-over-year revenue surge and guided well above expectations, describing the largest disconnect between memory chip demand and supply in 25 years, driven by AI data centers. Management highlighted that key AI-related memory lines are effectively sold out through 2026, and analysts expect memory price increases and margin expansion to persist as demand continues to outpace supply. That backdrop has triggered a double-digit jump in Micron's share price, lifted the broader semiconductor complex, and improved sentiment in Nasdaq futures, underscoring that chipmakers remain viewed as essential enablers of the AI build-out. Beyond chips, there are mounting signs that enterprise AI adoption is becoming embedded in corporate strategy rather than remaining a side experiment. Accenture reported record new business of $20.9 billion in its first quarter, up around 10% year-on-year, with management pointing to AI as a catalyst for client transformation across banking and digital manufacturing. At the platform level, Microsoft is seeing roughly 30% of tracked Azure cloud deals linked to AI, while OpenAI is racing to lock in users and personalize its services as competition from Google intensifies, even as it seeks to raise tens of billions of dollars at private valuations that have jumped from around $50 billion to the high hundreds of billions within a year. On the macro side, AI is increasingly showing up in productivity and labor data, but also in the energy bill. Despite flat U.S. employment since April, strong productivity gains, partly linked to AI and a narrowing trade deficit, could push GDP growth above 4%. Even as companies slow hiring and, in some cases, announce layoffs citing efficiency gains from technology. At the same time, AI-heavy data center demand is reshaping electricity markets, with capacity auction prices in the PJM power region leaping from about $2.2 billion to $16.4 billion annually, while residential electricity prices have risen roughly 13% nationwide. Severe supply constraints in natural gas generators, with firms such as GE Vernova sold out until at least 2028, suggest power availability could become a binding constraint on how fast AI infrastructure can scale, pushing policymakers and investors to look more seriously at nuclear and even fusion as long-term solutions. All of this sits against a valuation backdrop that is becoming more challenging. AI-related equities are experiencing heightened volatility, with recent surveys flagging a potential correction in AI stock prices as a top market risk for 2025 and 2026, and capex to sales ratios for the largest platforms rising as they fund ever larger data center programs. Big technology firms are already seeing lower free cash flows and higher debt loads due to AI investments, while private markets are testing extremes, with OpenAI reportedly exploring fundraisers at valuations between roughly $750 and $830 billion, far above levels only a year ago. Competition for capital between large private names, such as OpenAI and SpaceX, and growing uncertainty about how to value AI-exposed businesses is dampening merger and acquisition activity and increasing concentration risk for portfolios that lean heavily into a narrow set of AI leaders. Regulatory and political risks are also coming into sharper focus as AI diffuses across the economy. Instacart's 6% pre-market drop after news of a Federal Trade Commission probe into its AI-driven pricing tools illustrates how quickly sentiment can shift when regulators question AI use cases. And similar scrutiny is emerging around data center expansion as communities push back against higher power prices and generous tax subsidies. In parallel, U.S.-EU digital trade tensions are escalating, with Washington considering Section 301 investigations over perceived discrimination against American tech firms, even as bipartisan permitting reform in the U.S. aims to speed up transmission lines and data center projects that underpin AI growth. Looking ahead, key watch points within the AI theme include whether semiconductor and cloud earnings continue to surprise on the upside, how power markets and environmental politics shape the pace of data center construction, and whether the coming wave of AI-related IPOs and mega-scale private fundraisings can clear current valuation expectations without triggering a broader reset. Those AI dynamics are increasingly intertwined with geopolitics, particularly through energy and regulation, which is where we turn next. Geopolitics continues to exert a powerful pull on markets, with Europe's struggle to fund Ukraine now a central test of the region's cohesion and credibility. European Union leaders are debating whether to use frozen Russian assets to back roughly €90 billion in loans to Ukraine, but Belgium, which oversees a large share of those assets, is raising legal and currency stability concerns that are blocking consensus. The only real alternative being discussed is joint EU debt issuance, a politically fraught option, so failure to agree risks pushing Europe toward temporary stopgap financing, raising doubts about long-term support for Ukraine and the bloc's ability to translate tough rhetoric into decisive action. The uncertainty around funding comes as discussions on security guarantees for Ukraine intensify. Germany has signaled a willingness to contemplate deploying troops as part of a broader effort to deter further Russian aggression, a potential historic shift in European defense posture if it ever moves from rhetoric to reality. By contrast, U.S. policy toward Ukraine remains uneven, with fluctuating political support and mixed messaging undermining Western unity and, in effect, emboldening Russia to maintain a protracted military campaign while negotiations over any peace deal remain stalled. Energy markets are one of the main transmission channels for these geopolitical tensions. Oil prices are rising for a second consecutive day as risks around Venezuela and Russia, including U.S. consideration of additional sanctions on shadow, fleet oil tankers, and energy traders, outweigh ongoing worries about oversupply. At the same time, sanctioned barrels from Russia, Iran, and Venezuela are still finding their way to buyers, keeping global supply relatively robust and limiting how far prices have run. And some analysts argue that if geopolitical risk premia fade and demand softens, crude could test levels around $50 or even into the 40s, where U.S. producers would likely cut output and create a de facto floor. Europe's internal divisions over Ukraine funding sit alongside a broader push for strategic autonomy in defense and trade. Defense spending is rising across the region, deepening the order books for key suppliers, while leaders explore using frozen Russian assets via a collective legislative framework that would spread legal responsibility and potentially ease Belgium's objections. In trade, the long-delayed Mercosur agreement with Latin America is framed as a way to diversify away from China and secure access to critical raw materials. But opposition from France and Italy and threats from Brazil to walk away underscore how difficult it is for Europe to move from strategy papers to concrete diversification. On the digital side, tensions with the U.S. are flaring as Washington weighs Section 301 probes into alleged discrimination against American tech firms, raising the risk of retaliatory measures and further complicating cross-border capital and data flows. Beyond Europe, the geopolitical map is also shifting in Asia and in space, feeding into defense and safe haven trades. The U.S. approval of an $11 billion arms sale to Taiwan marks a notable escalation in U.S.-China tensions and adds to the regional risk premium that investors assign to Asian markets and supply chains. At the same time, a new U.S. space policy emphasizing lunar infrastructure and technologies, such as nuclear propulsion, largely executed through public-private partnerships with firms like SpaceX and Blue Origin, signals that aerospace is being treated as a strategic domain alongside traditional defense. Against this backdrop, rallies in gold and silver are being driven by concerns over fiat currency debasement and de-dollarization, as central banks and private investors seek partial alternatives to the U.S. dollar amid elevated geopolitical and monetary policy risk. For markets, the interplay of these forces is less about single headlines and more about how they reprice risk premia across energy, defense, currencies, and safe havens. A durable agreement on using Russian assets or joint EU debt for Ukraine could strengthen perceptions of European cohesion and provide a clearer path for war financing, while continued deadlock would keep political risk premia in European spreads and the euro elevated. In energy, the balance between new sanctions on Russian or Venezuelan exports and an underlying picture of ample supply will help set the trading range for crude, influencing everything from energy equities to inflation expectations. Key watch points now include the outcome of the current EU summit on Ukraine funding, any follow-through on U.S. sanctions targeting Russia's shadow fleet, China's response to the Taiwan arms sale, and the behavior of gold and defense stocks as barometers of broader geopolitical stress. All of this feeds directly into how investors frame the global growth outlook, which is increasingly defined by a tug-of-war between policy support, earnings momentum, and late-cycle risks. The growth narrative for the next couple of years is quietly turning more constructive, even as valuations and late-cycle signals keep investors on edge. Markets are currently pricing 2 to 3 Federal Reserve rate cuts, and the consensus is coalescing around mild global growth acceleration into 2026, supported by a combination of monetary easing, targeted fiscal expansion, and productivity gains tied to AI and digitalization. This is unfolding against a backdrop where the ongoing bull market is viewed as relatively young by historical standards, with past cycles at a similar stage often running for several more years, though always subject to shocks. In Europe, fiscal stimulus is emerging as a primary growth engine as the region tries to shift from a consumer-led recovery toward investment-driven momentum. Germany plans to boost debt sales by about 20% next year to finance infrastructure and defense, and broader Eurozone forecasts have been modestly upgraded on expectations of more public spending, even though growth is still set to lag well behind the U.S. The European Central Bank has held rates steady at around 2% and is stressing a data-dependent approach, with 2026 inflation projections nudged up to 1.9%, still just below target, helped by disinflationary pressure from increased Chinese exports and AI adoption. On the corporate side, earnings expectations remain a key pillar of the constructive growth view. Analysts are forecasting roughly 14% earnings growth for U.S. companies next year, helped by falling oil prices and a weaker dollar, while estimates for S&P 500 profits in the current quarter have held up unusually well. There's a growing expectation that market leadership will broaden in 2026, with sectors such as healthcare and industrials, and potentially small caps, contributing more meaningfully to index-level earnings alongside technology as AI-driven productivity gains diffuse. Broader earnings growth beyond tech and AI is anticipated from early 2026, supported by companies like FedEx, which recently raised its revenue growth guidance to 5 to 6%, and by robust order trends in areas like defense, healthcare, and digital infrastructure. High-end consumption and capital markets activity also point toward an underlying growth pulse. U.S. travel to the Caribbean has surged, with flight volumes up nearly 20% versus 2019 and visitor numbers to Anguilla climbing close to 200%, while the launch of Anguilla Air targeting winter travelers highlights sustained demand for premium leisure air travel. Private jet operators are seeing strong holiday season demand, with more longer, larger group trips to destinations like the Caribbean and the Rockies, and the luxury sector is stabilizing as high-end U.S. consumers and an improving backdrop in China support analyst expectations for renewed growth. In capital markets, a significant backlog of IPO-ready companies, particularly in AI and technology, is expected to drive a robust wave of listings over the next 12 to 24 months, including widely anticipated deals from mega-cap private names such as SpaceX, OpenAI, and Anthropic, alongside sector-specific offerings like Medline's recent flotation and growing merger and acquisition interest in technology, defense, and healthcare. One of the more unusual features of the current cycle is the combination of strong measured productivity with pockets of labor market softness. Despite expectations for a roughly 2 percentage point GDP boost in the first quarter from a rebound after the U.S. government shutdown, hiring remains sluggish, and companies in some sectors are explicitly linking layoffs to productivity gains from technology and AI. The U.S. labor market overall looks to be in a holding pattern, with job growth strongest in roles exposed to AI, while retirements and slower immigration constrain labor supply, raising questions about how evenly the benefits of the expansion will be shared. Rising electricity prices, partly driven by AI and data center demand, along with elevated valuations, especially in AI-related stocks and some recent IPOs, add to concerns that a misstep in policy, energy markets, or earnings could trigger a sharper repricing than the baseline soft landing scenario implies. Putting it together, the base case embedded in markets is one of soft landing that morphs into modest reacceleration, with AI-supported productivity, fiscal spending in Europe and the U.S., and resilient high-end consumption underpinning earnings and an extension of the bull market. Counter-arguments focus on stretched valuations, concentration risk in AI leaders, uneven labor market outcomes, and the possibility that geopolitical shocks or energy price spikes could quickly erode the still narrow window for monetary easing. From here, the key signposts for the growth narrative include upcoming inflation and wage data, whether earnings strength broadens beyond technology into areas like healthcare and industrials, the scale and design of German and wider EU fiscal programs, and the market's ability to absorb the coming IPO and M&A wave without indigestion. These factors will determine whether today's cautiously optimistic outlook on growth can solidify into a more durable expansion, or whether the cycle remains vulnerable to a policy or geopolitical accident. Across themes, today's picture is one of powerful but finely balanced forces. AI remains a dominant growth and earnings driver, yet faces rising constraints from power, regulation, and valuation risk. Europe's geopolitical choices on Ukraine funding and sanctions are shaping energy prices, defense demand, and safe haven flows, and markets are tentatively embracing a soft landing that could evolve into modest reacceleration if earnings and policy stay on track. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.